Welcome along. Thanks for making time to come and listen to the Squirrel webinar today. This is for our investors who invest on Squirrel's peer-to-peer platform. I hope lockdown's treating you all well. Squirrel's certainly continuing to work from home, and we're full steam ahead helping people out in whole different ways, shapes and forms. Today's session is scheduled to run for about 30 minutes. I'll stay on though as long as questions have been asked. So if people want to keep asking questions, I'll stay around and keep answering them. You can ask questions today. Best way to do that is using the Q&A button you'll see at the bottom of your Zoom screen. These sessions are always much better if you're asking questions, because otherwise it's just me blathering on and people get sick of that pretty quickly. So spice things up by asking some questions as we go. All right, there's three topics that I'm going to cover today. First of all, I'm going to give you a brief update on what's happening on the platform, and particularly what to expect over this lockdown period and maybe subsequent. Second thing, I'll give you an update on default rates and the data that we have on our website around default rates. Third thing we'll do is a very brief sneak peek at the new reporting module that's coming for our investors when you log in. So that's getting very close now. So I'll show you a couple of screenshots of what that's going to look like as we get to the end. So saving the little present there till the end of the webinar. All right, so let's kick ourselves off. Righty-ho, so what's going on the platform at the moment? So I guess during lockdown, we're seeing some loans continue to settle. We're also seeing some pushed out. Most sale and purchase agreements for houses these days have a clause in them that if we're in a hard lockdown, it allows the settlement date to be pushed out for 5 or 7 days. And that it can be on a continuous basis until such time as we're through that lockdown period. So what we've seen so far, so we're about a week in now, we've seen some loans still settle and we have seen some push out. That's primarily for our mortgage-backed loans. For our personal loans, we've seen a handful settle over the last week, but I suspect we're not going to see too many more settle until we get out of the lockdown period. The reason for that is, particularly for personal loans, once you've got that money, it can be quite hard to do anything with it during this lockdown period. So if you've planned renovations, you're not going to be able to have any builders working for you or anyone on site, those sorts of things. So probably likely to see pretty soft drawdown volumes from a personal loan perspective. All right. So as it stands today, I'm not aware of any home loans or business property loans that are under any stress, and there's certainly none in arrears as it stands right now. From a personal loans perspective, though, that was something that I was watching pretty closely when we went into the lockdown periods last year. And if we look back now with hindsight, we'd say, well, actually, we had nothing to worry about. The Personal Loans Reserve Fund did its job beautifully through that period. And if I look at where the Personal Loan Reserve Fund is at today, it's about $100,000 higher than it was in March last year. So actually, I would say Personal Loan Reserve Fund is going to do a great job for investors through the back of this lockdown. I don't expect there to be any particular risks other than normal risks that exist. What else have we got here? We've also de-risked the personal loan portfolio a bit, particularly from January this year. So we've really changed some of the things that we're doing from a personal loan perspective, which has seen less risk in that portfolio. And I'll talk more about that when we get into the default rates. Reserve fund coverage ratio today is also around 5%, which if we look globally is actually really high. So while there's no guarantees in life, I think that personal loan reserve fund's in good shape to weather any storm that's thrown at it through this COVID period, with last year's lockdowns as a background. Alrighty. So I thought I'd also give you a brief update on our Launchpad loan product. So some of you may have joined our webinars that we ran when we launched the product back in April. So since then, we've seen really strong inquiry. We've had over 1,200 applications since we launched. Around 1 in 4 of those has become a qualified lead. And so that means that the customer is in with a shot of getting approved for a loan. They may not have quite finished saving yet, or maybe need to pay down a bit of consumer debt, or they may not have found a property yet, or they might be attempting to find a property or going to auctions and just not being successful at this point. We have settled 6 loans so far, and there's more in the pipeline. We've had one delayed through the settlement through this lockdown period. The settlement's been delayed, and we've got one further one that's due to settle, I think, on Monday next week. I fully expect that that one will also get pushed out. There are another handful or so that we've already got scheduled dates for during September, October, and I think there might even be one in November now. And as the market opens itself back up, once we get through lockdown, then we can expect more and more loans will get to the point where they're ready to settle. On average, we've seen the personal loan component of the Launchpad product. Those loans are around 100,000 each. So, you know, once they start cranking through, they start chewing through that 5 to 7 year personal loan investment order queue that sits there today. All right. So that gives you a brief update on what I see in the portfolio. Feel free to ask questions as we go, and I'll try to answer them as we go. What I will do now is I'm going to start talking about our default data. So we truly believe in transparency, and we publish a huge amount of information on our website about how the portfolios are performing. What I'm going to do is I'm going to share my screen and talk you through some of the data that's on our website and make sure that you understand it. So give me a second while I do this. Okay, so you should be able to see a PowerPoint screen there now. Let's move on to the first page of data. Nearly there. There it is. Okay. So what you can see on this page, you'll find it on the investments tab of the Squirrel website. So if you go to the Squirrel website, you go to the investments tab and scroll down, you'll see a table that looks just like what you're seeing on your screen right now. Let me talk through each of the columns of data. So first column is the size of the loan portfolio. So 12.4 million of retail investors who have invested into personal loans. That's what that represents right there. You can see the home loan box 5.7 million and the business property loan box just over 30 million there. So that's all pretty self-explanatory. Next column in the table is our reserve funds. So you can see there's just under 600,000 in the personal loan reserve fund, just over 100,000 in the home loan reserve fund, and you can see there's almost 230,000 in the business property loan reserve fund. Next column are our coverage ratios. So that's basically taking the size of the reserve fund and dividing it by the size of the loan portfolio. So you can see we're just a bit under 5% coverage ratio for personal loans. I mentioned earlier in the presentation that that's a really high ratio in a good way. So that means there's lots of coverage there. If you look globally, most reserve funds kind of sit in that 1 to 2% range, depending on the nature of the risk in the portfolio. So to have the personal loan reserve fund up at close to 5%, that's really high. For the home loan book, that's at 2% as it stands right now. That's in good shape. For the business property loans, it's a bit lower than where I'd like it to be long term, but in the short term, I think that's in pretty good shape. Reason for that is that the business property loan investment portfolio has grown really quickly. So because it's grown so fast, it doesn't give a lot of time for those regular payments to be dropping into the reserve fund, and therefore the coverage ratio is lagging a bit based on just the sheer growth that's going into the portfolio. I mentioned earlier that we have no loans in arrears in home loans or business property loans, and there's none that I'm aware of that are under any stress at all. So no cause for concern there. Anyway, that ratio is there and data's on the website to keep it transparent, as we discussed. Next column looks at the expected borrower default rate. So we do quite a lot of modelling to look at what that rate might be. We've now got 6 years worth of history with personal loans, which gives us a really good feel for where things are at. So the expected borrower default rate on the personal loan portfolio as it stands today on the active loans is just under 1%. If you followed this particular table and data looking back in time, you would have seen that that rate would have been higher, so maybe around 1.3%. And I think what you're seeing there is the evidence of us taking some risk out of that personal loan book, and you're seeing the expected borrower default rate reduce as a consequence. So that's a good thing. That's an indicator of the amount of risk that sits in the book. You'll see that we haven't published yet for home loans and business property loans what those expected default rates will be. We've got some modelling in the background. We're just letting those portfolios build up just a little bit further before we publish those rates. If I had to make some educated guesses right now, based on some of the modelling we've already done, then home loans, I'd expect that rate to be at about 0.25%. And for the business property loans, perhaps about 0.45% or maybe as high as 0.5% in that space. I'd expect that we'll publish our expected borrower default rates later this year. Last column in this data is the amount of reserve levy that we're collecting on the active loan portfolio. So at the moment, you can see we're collecting 2.18% per annum on the personal loan book. And if you look at that expected default rate of 0.96, it's more than double. So we take a pretty conservative approach because we want to make sure investors get looked after in that sense. If we then stroll through to our home loans, that reserve levy on the active book is 0.63%. That's quite high, but while these portfolios are young, I think it's important that we continue to build as quickly as we practically can a decent lump into each of that reserve fund and also the business property loan reserve fund. For the business property loans, you will have seen, for anyone once again who's watched these tables over time, that number's been a bit higher in the past. It just depends on the nature of the loans in the portfolio at any one time as to where that rate will be, but certainly ahead of what we think that expected borrower default rate will be in the future. Okay, so those that data I actually look at every day, keep a really close eye on what's going on there. So doing that on your behalf, perhaps. And feel free to ask some questions on any of those ratios or the way that we've presented that information in the table. What I'm going to do now is flick on to one more part of the portfolio. So give me 1 second. So in here, there is a lot more data that we do publish. So if you go to the investments tab on the website, you'll see there's a default rates button on the menu. If you go to that default rates part of the menu, there is a heck of a lot more data there. There's a couple of, I'm not going to go through all of that data today. I will just highlight a couple of points though. All right, so on that default rates tab for personal loans, you'll see that we score each of our borrowers with a credit risk grade of A through E. The stronger the borrower, the higher the grade. So a strong borrower will be an A and a weak borrower will be an E. Also, from those risk grades, we then set the reserve levy for the borrower. So if you're a higher risk borrower, then we set a higher reserve levy on your loan, expecting that the default rate for that loan could be higher. So they also then pay a correspondingly higher interest rate on their loan. We cut the data lots and lots of different ways on the website, so you feel free to go and have a look through that, and you'll see it there. For our home loans and business property loans, we actually assign a borrower risk grade of A through E and a security risk grade of 1 through 5. So the borrower risk grade reflects the person's credit score. their financial position and financial conduct. Broadly speaking, there's a range of measures that go in there, but that's broadly what it covers. So we're looking at the individual and seeing how they've performed with loans in the past. And then we also then look at the security grade. So with all of the loans now, home loans and business property loans are secured by first mortgages. So we go and look at what that type of security is. So is it a bare land, or is it a section with a house on it? If it's a house, what sort of house is it? We also then look at where that house is located. Are we talking metropolitan locations or provincial, for example? And we also take a pretty good look at the title and make sure the title's fit for us to lend against. So that security grade is 1 through 5. So each of our home loans and business property loans are given a rating of for example, an A1, which would be a very high quality borrower and very high quality security. It could equally have a B2, for example. So each of the loans has that grade. And we've published data on the website once again in that default rates tab on the loans that we've written since day one. And the loans that are in the active portfolio as it stands right now. You'll also see some graphs on those pages. So one of the graphs for personal loans shows the net write-off rates by loan cohort. So we take kind of 6-month chunks of loans and we've tracked them over time. And you can see that over time, the default rates that we're experiencing are getting lower. And I think that's partly what you're seeing from us de-risking the book over time. For our home loans and business property loans, you'll see graphs in there which show our arrears rate. So if a loan goes beyond 30 days arrears, then we'll indicate that there. Those graphs have just zeros in them at the moment because we've never had a loan go more than 7 days in arrear, and we only recorded it once it goes sort of 30 days in arrears. For the number of loans that have gone into arrears in that space, we've seen just a handful, and the majority of those just administrative errors on behalf of the borrower, where they didn't have enough money in the account on the day, or had forgotten to transfer money over, for example. We did have one loan last year through who had their income particularly impacted by COVID. That loan's subsequently worked its way through the portfolio, got back into normal, and then subsequently paid back. Alrighty, I'm going to take a breath there. I see there's a couple of questions that have popped up. So let's see the first one here. First one from Adrian, quick question. Yet to begin my investment journey, thinking of starting investing in personal loans. With regards to risks, what are some of the risks a beginner investor needs to consider prior to committing? I think first one is you can invest for a variety of terms. So you think, well, how long do I want to have that money out? How long is it at risk for? So there's one question. The second question I'd ask then is, what sort of credit risk am I taking here? And if you go to the investor handbook, which you can find on our website, that gives you quite a good description of the types of credit risks that exist for personal loans, and how we consider, the sorts of loans that we'll consider and the sorts of things that we won't consider. You can also then look at how we help manage risk on your behalf. So first of all, we obviously do credit analysis on each of the loan applications that we come through, and we approve some and we decline some. So I guess take that into account. And then certainly, last but certainly not least, is our reserve fund model. So reserve funds step in and make payments on behalf of borrowers if they miss a payment, or if the loan goes into default. So I think we handle risk in a whole range of ways, and there is a large amount of information on our website for you, Adrian. I'd go and have a look there. Hopefully I've answered that question for you at the moment. There's another question here from Peter. You've mentioned that you hold the reserve fund and trust. I take it you've invested it for a good rate. Can you share information regarding that? All right, let's answer. Looks like there's two questions here. I'll answer that one first. So the money that's sitting in our reserve funds today sits in a bank account. So it's not being invested on your behalf. It's held on Bear Trust by Squirrel peer-to-peer trustees on your behalf in a bank account. We are looking at how we can invest that, and I think we'll have an option coming up just after Christmas for that. So that's something we're actively working on. And the interest from that, we'd expect will go back into the reserve funds to ensure that the reserve funds stay well capitalised over time. So the reserve fund money is held on investors' behalf by the Squirrel peer-to-peer trustees, and it's held on Bare Trust. In the event, so Squirrel as a company can't get our hands on that money. That's there for investors' behalf. In the event that the loan portfolios are wound down to zero over time and there's money left in that reserve fund, then it's given to charities. So that gives you a sense there. Second part of your question, as we've had no major drawings on the funds, though we've experienced some major events, lockdowns, what other type of major financial event could result in a significant fund depletion? So it's probably the answer to, there's two parts to the answer there. The first part, if I look at our personal loan portfolio, the thing that I really care about there is what the unemployment rate's doing. So a big rise in unemployment. So let's say we get to double-digit unemployment in New Zealand, that would see the reserve fund starting to run down. It's a question of how long it runs down for, really. So modelling that we've done at different stages in the past suggests that the reserve fund for personal loans could easily survive more than 12 months with unemployment rate in double digits. So I think the modelling primarily focused at around 11 to 12%, which, if you look at New Zealand's history, would be historically a very high unemployment rate. Clearly, if you get into unemployment rates of 20 or more percent, then it's going to become depleted faster. So for personal loans particularly, really focused on that unemployment rate as a key indicator of economic risk, if you like. So, through that COVID period, or if we look at sort of March, April, May, June last year, the reserve fund held about neutral. So it went up a bit one month, went down a bit next month, and just bobbled around about the same level, and then subsequently started to recover. So I think that's a really good indicator of what could happen in the event that we saw some pretty big unemployment rates roll through. Mentioned there was two parts to that answer. For home loans and construction loans, probably more interest, there's certainly general economic indicators that we keep a pretty good eye on. The employment rate is one. Also quite interested in house prices. So if we saw a consequential fall in house prices, then that starts putting some of the security at risk in the event that the borrower does default. Clearly, we don't want that to happen. So, watching house prices, that's important. Remembering that for home loans and business property loans, we've got our LVR or set at 70% or 80% or less. And on average in the portfolio for home loans, it's around 70%. And for the business property loans, it runs at just over 60% today in round numbers. So lots of equity there in the event that those loans do default. So hopefully I'll give you, there's probably a longer answer than what maybe you're hoping for there, Peter, but it gives you a sense of it. Feel free to answer some more questions, ask more questions off the back of that if you'd like. What I'm going to do now, just to make sure I've finished the prepared material before 8 o'clock, is I'll just give you a quick overview of the reporting suite. This will just take a couple of moments, and then I'll get into answering other questions that you have. All right, so we are due to launch stage 1 of our reporting suite. It'll either be next week, it's in testing with our technology team at the moment. So it could be released as soon as Tuesday next week. If we don't quite get it through testing and we're not quite sure that it'll be ready, then it will definitely be the week after. So you can expect a view that looks something like this to arrive for you logged in, when you're logged in through the browser, which gives you a much better view of your portfolio, what orders you've got waiting, what your active investments are, for example, and splits it up. There's some cool things that the pie graph will do. So if you click on a portion, it'll split around to different groups where it's relevant. And there's a couple of other elements and parts of that view that will be there. So that's the first stage. You'll see things like that deployed. And then a few weeks after that, you're likely to see a table that looks somewhat like this come through. This has a lot more data on it. You'll be able to download the data. You can select a date range that you want to see this data for, and filter it by different classes. We'll also give you things like a repayment projection. So based on the maturity profile and the amount of money that's going to be repaid to you if you've got principal and interest loans. So you'll be able to see things like that. I'm just showing you one of the screens here. Lots of data. We think will be really helpful for those that have a more analytical bent to their portfolio. So this is just a very sneak peek, and I'll turn that off now. But yeah, so hopefully next week you'll see the first part of that. If not, it'll be the week after. And then a week or two after that, you should see the final piece live for you. I will certainly send a message out once we've got that live. So keep an eye out for that in the not too distant future. All right, I'll stop sharing that now. Okay, back to some questions. So thanks, Adrian. Looks like I answered your question earlier. And then question here from Michael. Glad to see qualified borrowers and personal loan rising well, probably according to your new additional model. What's going to happen now during lockdown where those potential borrowers might not be able to use their loans as intended? Would they withdraw from their loan requests? I guess based on what we saw in the different lockdown periods that have been in the past, we will keep a loan that's in our pipeline, so it hasn't settled yet, live for 30 days. And at that point then, we'll go back to the borrower and check to make sure that nothing's changed. So the last thing we want is to have approved a loan, let's say prior to lockdown. Let's say the borrower then loses their job during lockdown. They didn't settle the loan prior to lockdown. So they're in this kind of state where all of a sudden their circumstances have changed. So we go back to those borrowers and make sure that nothing's changed before they go ahead and draw those loans down. We expect that most of them that are in our pipeline will remain in our pipeline. Of course, you'll get some that will drop out, circumstances change, and that's okay. Yeah, so hopefully that gives you a view on that one, Michael. Thanks for that. Next question, thoughts on reducing the minimum investment amount from 500 down to, say, 100. It's something I'd like to do. However, we're slightly hesitant in doing that at the moment. The reason is if we fractionalize a loan down to a $100 unit, it means there's a lot more rounding that goes on. And that's not an ideal situation where there's lots of rounding. It means, 1 cent here, 1 cent there, over lots and lots more fractions of loans isn't ideal. And it also means that our investors will end up with lots more $100 investments in their portfolio if they set their, for example, auto reinvest at $100, then $100, they'll see lots and lots, they're invested in lots and lots more loans. Over time, we think we can smarten up one or two things that we do, which might make that possible. But for now, we're going to leave it at $500, which we think is an achievable amount for most people. So hopefully that answers your question there. Thank you for that one. Another question I noticed on the web page you shared below, you're going through the various personal loan risk grades that you have thoughts on high or no arrears rates for BCD and not E, highest risk. I guess the key thing when you look at that data is there's very few loans in that E category. We tend not to write many, as you can understand, they're high risk loans. So there are the occasional ones that were written over time. We pay so much attention to them that those loans tend to perform quite well. If we look at what an E grade loan might look like, it could be that the person has had some nasty defaults in their credit profile, but they've subsequently started to recover. So their credit score can be really low, but now they've got a better job, or they've started showing that they're paying back some of their loans. So they may still be rated an E, but they're on a better path to improving their credit record. So yeah, we have very few loans in that E category. In fact, we don't even have many in the D category, as you'll see. So that's one of the reasons why you don't see too many in arrears in that space, is because there isn't very many of them. Thanks for that question, Adrian. All right, question here from Mark. Will you be at some stage updating your platform so that when I get to place an order, I can determine if I have already invested in a particular loan? It's a harder thing for us to show for a range of reasons. Because you're in a queue, you don't actually know which loan you're going to end up being allocated in. If you find that you end up with all of your money in one loan, and you don't feel comfortable with that, despite the fact that the reserve fund acts as your diversification mechanism, then you can actually choose to sell some of that on the secondary market. There's no cost for you to do that. So you can, let's say, go through a rebalancing exercise, might be the best way to describe it, for your portfolio, simply by popping some on the secondary market and then reinvesting in whichever different investment class or into a different loan once you've had that money returned to you. So hopefully that answers your question there, Mark. It's a hard one for us to provide when you're in the queue, because we only know what you're going to match to at the time that you're at the front of the queue. And as I said, you can always sell some down on the secondary market if you feel like you want to rebalance your portfolio in some way. Hopefully that answers your question there, Mark. Thank you for that one. Okay, no more open questions in the Q&A section. I'll give you 30 seconds more. Oh, Adrian's jumped in with one final question. Do you provide consultation with regards to portfolio design and considerations? So I can't provide you with independent financial advice, Adrian, but if you want to book some time with me, which you can also do through the investments page of the website, I'm happy to chat generally about the risks and your situation generally, and give you some things to think about, but it won't be personalised financial advice. I'm not able to give that to you, sorry. So yeah, feel free to book some time with me, and in fact any investor can choose to do that through the investments tab of the website. You can book a 30-minute appointment with me. It'll bring up a diary, so it'll slot you into, or you'll see the different slots that are available. And yeah, feel free to book that time. I'm more than happy to answer investors' questions at any time with what we do. All right, I'll give you one more piece of information, but feel just to see if there's any other questions that surface. I ran this webinar this morning, or sorry, at around lunchtime for investors as well today. And one of the questions was, well, how's Squirrel doing financially? Is Squirrel performing well? So to give you a sense of that, there's a couple of parts to the answer. So if I look at the Squirrel group, we're performing really well. Our revenue in the last financial year was a bit over $14 million. We are profitable, so we're generating a profit, albeit we're investing a lot of that profit straight back into the business because we're intending to grow ourselves quite a bit larger than we are today. As you may know, we have a really large team of mortgage advisors. Those mortgage advisors have increased the volume of loans that they're settling with various banks from just over $1 billion in the prior financial year, in the last financial year, and this year we expect that number to be around 1.7 billion that they'll settle. So it's some pretty enormous growth going on there in that part of our business. And then for the Squirrel Money business, we're also growing pretty strongly. So our loan book as of March 2020 was at about 16 million, give or take, of investor funds. And today we're getting up to investor funds of well over 40 million. I'd hope that by the end of this financial year, so by the time we get to March 2022, that our investor funds under management will be much closer to 100 million. Whether we get to 60 million, 80 million, or 100 million, I don't know yet, but we're intending to grow quickly. We've got some more things in the pipeline that will help us grow and do that coming in the very near future. All right. Looks like one more question's popped up here from Lance, so I'll answer that one, and then unless anything else pops up, we'll call it quits there. Okay, so a question from Lance is, do you see the loan coverage ratio for business loans improving soon, or prefer to let it grow first? what we'll see is probably it's going to hover around about that 0.9 to 1% range, I'd expect, assuming that the rate of growth remains constant as it is right now. So I'd expect that we'll continue to see it hover around that space. As I said, there's no loans in arrears. We've hardly had a loan in arrears in that space. There's certainly no loans headed towards default in the portfolio, and none that I'm particularly worried about. I think we'll continue to just let it run in that space. The fund's continuing to grow. Remembering it started at 100,000 in that the business property loan reserve fund. So since we launched that in March 2020, it's grown to 228,000, which is some good growth, and it will continue to grow from here. Over time, I'd expect that ratio will begin to improve and get to perhaps 1.5% would be kind of where I want to see it in the medium term. But yeah, we'll certainly keep a close eye on it. So hopefully that answers your question there, Lance. Thank you. And just a comment there from Peter. Thanks for your time. All right. No other questions have popped in. So thanks very much for your time, everyone. Great that you were able to join me. Hopefully you found that useful. And yeah, enjoy the rest of your evening. Hope lockdown goes well for you. I'm here in Auckland, so I've got a few weeks to go yet, I suspect. All right. Thanks, everyone.